Sounds good.
Hey, welcome in,
Hello,
folks.
folks.
It's been
Hey,
a
Bill and
few
Brian. And
weeks.
guess what? It's
What?
been a few weeks. We are actually
I
live
know.
today.
I know.
I mean,
What's
it
up
is
with that?
lunchtime. And listen, we appreciate you spending your lunch with us.
Zoinkers, this is going to be a boring one.
Yeah, it could be. It could
Yeah.
be.
So,
It
uh,
could
s-
be.
so listen. Today we are in September, and at the end of October, there's a holiday, and the holiday is what? At the end of October, what holiday do we get?
I thought it was your birthday. That was the holiday.
Now we get Halloween, which is also appropriate, and that is also coincides with the end of natural gas storage season. And the end of natural gas storage season sets the tone for the winter and winter pricing. So,
So, what are you
um,
doing? Are you promoting that we should have an end of storage holiday? We can call it
well,
the injection
if you
holiday.
if you
Well, that
think
might be
about
taken
it,
wrong.
the end of injection season ends on Halloween, and
Yeah.
when does the end of withdrawal season
It's
end?
a April Fool's Day, right?
Yeah, so here we go. Yeah, if you want to talk about how crazy natural gas is, yeah, you end injection season on Halloween, and you end withdrawal season on April Fools. So one of the
So,
key
folks,
things.
because we're live, just a little quick housekeeping. Reach out in the comments. We'll respond to them as we see them come in, and so we're more than happy to respond to those. So, if you're watching live, send us a comment. If you're not watching live, send us a comment, and we'll get to it.
Yep, absolutely, absolutely. So what we're going to do is we're not going to make this a long live stream. However, what we're going to do is we're really going to talk about the fact that storage drives a lot of pricing and a lot of volatility when there are expectations on weather, demand increases, supply increases. This impacts prices. So, what we typically look at is we take a look here at Energy Rogue what the end of season storage number looks like. So what we do is we actually evaluate what is going on in the current market, and this is the current projected based upon averages. And Bill's going to go on a rant on averages in a second, but we have a tool that you can identify what the end of season storage is. And based on the 3-year averages, not five, three, and there's a reason that we picked three, we are looking at 3.916 on end of season storage, which is in line with most of the analysts. There's about 38 analysts that have been polled, and I think the average or the mean is like 3.92. So this is right on top of that. So this is what typically happens is you take a look at that. What we did is we created this tool that says, well, wait a second, let's say we increase summer production by half a BCF. What does that do? Well, that changes your end of season storage from 3.916 to 3.944. So we can go in and actually evaluate and let's go ahead and make up something. What do you think, all things being equal, supply and demand being equal, what do you think we'll see? More demand, more supply? I have my opinion. What's your opinion?
What time frame are you talking about?
Uh, the next 45 days.
Next 45 days? I think, well, because it's a shoulder month, we're going to see demand go down a little bit. We'll see storage injection peak up some.
Well,
So,
seasonally corrected. In other words, versus the last 3 years.
versus the last 3 years,
Yep.
I think demand will be a little bit high. Will be higher than the last 3 years.
Do you think it's residential, commercial, industrial, power? Where do you think it's going to be
Power.
higher?
It's going to be in the power.
Okay, how much? Half a BCF?
Burn 43. No, I'll just go with half BCF. Let's just play the game.
All right. So half a BCF would take us to 3 point, right there, 3.8. So 3.8 TCF. If everything else is equal, we're gonna exit 3.8, which has been our number all season long. We've been sitting at a 3.8 most of the way. Well, no, I take that back. We were at 3.7. We revised it to 3.8.
We started out at 3.7, but to me, one of the big things is I think that storage should be getting. We should be needing more storage as time goes on because our demand is going up
Right.
on an incremental basis, and we don't see storage actually growing. And
Yep.
so we should be needing more storage when we start the season to be able to handle the demand. And so I think that we should see the peak in storage increasing over the last 5 to 10 years.
Yeah. Or said a different way, if we take a look at balance right here and we take a look at storage. Okay. So if we go back over time, let's clean this up. And there we go. Just have a nice clean graph. What you can see is that since 2012, we've essentially had the same range,
Right.
taking out some of the extremes, 1.5 to 3.8, roughly. And sometimes you're below, sometimes you're way below, sometimes you're above. So that's what Bill is talking about since 2012. Now let's go ahead and go back. I think our supply.
So let's look at the production increase since then, though.
I know that's what I was getting to. Stay with me, Bill. I know. I actually our supply, because this data source drops off in 2016, but just from
It shows the
2016,
profile. Yeah.
we went from 70 to over 100. And what you can see here is that we're not really growing that much anymore. I mean, we have big leaps right here and right here, and then a steady climb right there. But realistically, so we added, what is that, 35 BCF.
A day.
And 35 BCF is going to equal what, 50% increase. So that's a 50% increase of supply. And for this exercise, we're just going to consider supply and demand static. So when you think about supply and demand is going to be very seasonal. Supply is pretty much year round.
So there you go. Once you go back to your storage model. All right. Now, just add 35 BCF a day of 35 BCF a day of additional storage.
The scale doesn't go to that. It goes to plus or minus 2 BCF because on a 3-year band, we're not seeing that. So it's a 3-year
So here's what
model.
I'm saying. If we didn't have the production increase, it
Yep.
would have had to come from storage.
Yeah, completely.
So the reason the storage tops out the same place every year is because production is increasing.
Right.
So any decrease in production should take that storage in at the end of withdrawal season to a low number.
Yep. So most of the analysts are expecting about a 3.9. We've got our number at 3.8. And right now, if you increase the power by half a BCF over the next 45 days, I'm actually, even though Cove Point is down, I'm actually going to increase LNG exports by 3/4 of a BCF because we do expect a little bit more LNG output. And oh wait, this on exports is this way. So right here. So that takes us to kind of our base number, which is 3.84. So
what happens if you pull out just a little bit of Canadian imports?
like a half a BCF.
Yeah, no more than half BCF.
Well, let's make it a quarter then. So what that does is that takes us almost 100 BCF down, 3.83. 3.83.
All this to show is that it's not a static number, and there's not just one thing that affects where storage is. What storage does affect is how we enter into the winter season. Now, when you look forward to the winter season, when we start talking about where we're going to come out of storage out of at the end of withdrawal season, that's all based on weather. Everything I'm seeing is not so much a very cold winter, but a very high precipitation winter where there's going to be a lot more snow than what we've seen in the past couple of years.
So with this model, with this expectation of quarter BCF down from Canadian imports, half a BCF up of power, and more LNG exports, and everything else stays flat in the winter, if we have that model, we exit storage season at 1.6 TCF. And that is way below what people are projecting. Most are projecting about a 1.8 TCF at the end of withdrawal season. So this model, we can actually go out and forecast so much. But here's the thing. If you are interested in natural gas storage, that means that you're likely interested in natural gas markets. And if you're interested in natural gas markets, there's a couple things that you can do. One is you can just look at the technicals. Many people have access to technicals. I look at TradingView all the time. They got a lot of great tools and whatnot. But that's only going to give you one lens of the marketplace. So you don't really have access to a true what's happening to supply, what's happening to demand, because that's going to set the anchor. So we have two offers for you. One is Rogue Radar, $89 a month. The other is Rogue Edge. And if you liked what we were doing on this modeling and you were getting into that and that's your jam, it's $179. There is, if you go to the link in the description, you'll be able to see the difference between Rogue Radar and Rogue Edge right there. We do have a Discord channel that we focus on the $179 a month plan on Rogue Edge, and Rogue Radar is kind of an entry-level product. And inside of Rogue Edge, you get a video, couple of PDFs a week, and in those PDFs, we identify a red light, green light, yellow light for every factor for natural gas and every factor for crude oil. Plus, we give you our takeaways of what is happening on the fundamentals, what's happening on the technicals. So that's $89 a month. That gives you access to that. Plus, inside that $89 a month package, you have access to Natural Gas Radar, which is running every single night, which takes my thoughts on the market from the previous day, what is actually happening, technicals, fundamentals. This gives you all the basic fundamentals for the current, last week, last year, and 3-year average. So, and weather, like we do this every single night. And in addition to that, I know there's a lot of different opinions on AI. We actually have an AI summary for energy traders, for producers, for consumers, for commodity professionals. as well as machine learning price projection. So what's interesting is that this is actually projecting that we are going to go to 3.03, and where are we today? Oh, that's actually pretty interesting. So yesterday we were up around 312, and this machine learning was actually projecting, where is it? There we go. That we'd be at 303 today, and we're at 308. So directionally, it was right. So,
They're
interesting.
getting smarter.
That I don't know about that. I take all machine learning and all AI with a grain of salt, especially when it comes to opinions on the market or trading on the market. And it's part of the reason we actually combine human intelligence and AI intelligence and give you both. And you have
Right.
access to that at our entry level plan at $89 a month. So
Hard to beat that.
it
Cheaper
is
than a
hard to beat
Starbucks
that.
every day.
It is hard to beat that. But during the winter, do you think the Canadian imports are going to be less?
I don't know. It depends. Kitimat's coming on, and they've got one more that looks like they might be ramping up a little bit.
Okay,
So that's I don't think their production's going down. I just think it might get diverted.
right. Nope, that makes sense. That definitely
But there's
makes
still a lot of
sense.
things going on between Alberta and Montana. That's sort of a weird thing anyway, too. So
Right.
we'll sort of see how that works out as well.
Yep.
And so that's why I have. I think we could see, and of course they're growing, so their demand's growing as well.
Yep. Well, and here's the thing is that I love our daily Rogue Radar because it puts things in a very clean format where we take a look at the supply demand balance on the current week. You can see it from this last week was 12.8. Last week was 12.3. Last year was 9.2. And the 3-year average was 10.2. So that tells you that it's a little weaker than the 3-year average. So that tells you on your supply demand balance, um, we should be in a bearish cycle, and we seem to be going opposite of that right now. Now,
Brad,
this.
one thing we need to look into, and we'll just do this live because we're always having these conversations.
Mhm.
We probably look to see what's going on with AI in Canada. That would be an interesting discussion. See how they be using gas for their AI
You know what?
off their grid.
That would be a great location for it because the ambient temperature would be a lot lower.
Exactly,
That's
and they're
actually
technologically
interesting.
advanced, and so you know, they've
Yeah.
got to be somebody who's got to be working that. Those Canadian companies don't walk away from that stuff.
No, 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 no. And it goes into they have access to a lot of natural gas and a lot of crude oil. And one of the interesting things is that there's a dynamic to where when crude oil prices are high and natural gas is low, they use a lot of the natural gas to lift the crude. And when the inverse is true and natural gas prices are a little higher and crude is a little lower, they actually produce more natural gas. So that would be a great utilization for it, especially right now because natural gas prices on a relative basis have gotten stronger versus crude.
Right.
Um, because last year we were a little bit higher on crude, but half the price on natural gas. We've almost doubled in the last year. But I will say this winter, get ready because volatility is coming and there's going to be a big volatility run for natural gas this winter. Um, so anyhow, our number, or I say our, my number is 3.8 TCF on end of season storage. Most of the analysts out there are about 3.93. So I'm about 120 BCF behind that. Meaning that I think over the next 45 days, we're going to see less storage go into the ground. And I think there's a couple drivers on that. But what do you think your number is, Bill?
I think I'm going to, believe it or not, I think I'm going to short you. I'm going to go with 379.
Ooh. Now, are we playing Price is Right rules?
Uh, yeah, we'll play Price is Right rules.
Not many people
And
get that joke anymore. The
yeah, I
Price
know.
is Right rules. I
Well,
don't think people
the
watch
fact
that.
that it's still showing on TV is amazing to me. Um,
Is it?
no, yeah, I think we could see. I think we could see uh, some production reduction. Let's keep all the rhymes going here. Some production reduction,
Oh,
and
listen,
so
we did have Robert. Hey, Robert, nice to see you. I missed this
Robert,
earlier.
come on, Robert. Every time we get on here, you're always saying that they're never going to drill any gas wells. I don't know if you're like projecting this or what's the
No, and,
deal.
and he says it because he's right. Because the cost to drill those high cost wells in Haynesville, Utica, and some of the places that Robert is looking at, the cost to drill is just too high. You need 450 or above, 450 or something like that, four above. And
Yeah.
this winter, you're going to see four. You might even see five. Um, so, um, so Robert, completely agree with you. Bill's just razzing you. He's trying to get you $6. Robert says $6. Woo! You know what? For good economics, I wouldn't be surprised.
Well, I think it's just not even just the price of it. The fact is that most of it's done with borrowed money until interest rates get a little bit lower. I think you might be right.
Yeah. Well, we are seeing a trend in natural gas, and I will go ahead. I was going to close it off, but I will pivot to this since we're talking about this. One of the key things that I was looking at recently, let's see, is on the trends. When we look at crude oil, we have increased a 30,000 barrels a day this past month on 13.4 million barrels a day. One thing that's interesting to me, all the indicators are showing that we are actually in decline as a whole in the United States. So we are in decline. Now, when you go into the weekly numbers, you will see us being flat on production or increased on production. This is raw data that takes decline numbers that are estimated and new wells and adds them together. So when you walk through that math, we are in decline, meaning we should be losing 100,000 decatherms every single month. However, we're roughly staying flat, sometimes growing. And Bill, you know the reason, don't you? Two reasons. Two reasons.
Two reasons.
What's the two
So
reasons?
the reason we're declining is because one, you can't afford to operate even at these numbers, right? Is that what you're asking?
Nope. Meaning we should be seeing decline, but we're not seeing it in the weekly numbers. So why aren't we seeing gas production decline on the weekly when we are actually modeling and evaluating declines should be happening
Well,
across the
so
country?
well, one is the um, Marcellus. I mean, they don't have a decline right now. They can keep theirs
Right,
flat because of the pressure that's there. They
right.
don't. It's that's one reason. Um, so what was the second reason you were coming up with?
The two reasons, number one was going to be in Haynesville, in Utica, they are throttled back on pressure. So as conventional
Right.
wells decline, they are actually adding a little bit more. So it artificially masks the underlying decline that is happening. So that is one dynamic. The other dynamic is the Permian oil to gas ratios because Permian is getting gassier and there's more gas coming out per well drilled.
Yeah, the
So
Permian though is more of an infrastructure play. I think once you get up there into the Utica, that is really just managing wells.
yeah,
And it also is an infrastructure play because they could actually outproduce the infrastructure if they
yep.
wanted to.
Yep. Well, listen, folks, thanks so much. We wanted to keep this kind of short, but we wanted to talk about storage because end of season storage is going to be important. And if you follow natural gas and it's important to you, stay educated. There's a couple different ways. One is you could follow the technicals out in the marketplace. You could track down all the fundamentals all over the web, and with EIA, with EIA, Baker Hughes, as well as the Railroad Commission in each one of the states. Or you could sign up for Energy Rogue, $89 a month, and have access to weekly reports with our narrative on the market. So we provide our narrative on the market and we give you the tools so that you can know what is actually happening underneath the surface for natural gas and not be surprised. So that is what that is what we do. There's a link down below for anybody that wants to join. And there is a 14-day free trial. So that's what we have today. We really appreciate you coming by. And listen, at the end of the day, we want to bring information that is important to you. So we want to hear from you. If there's something you want to hear about, just feel free to let us know. We're here for you, and we appreciate you, and hope you have a fantastic day.